My name is Tyler Rodabaugh, and today I have the pleasure of presenting my systematic trading strategy, Volcanoes. So up front, we've got 45 slides in 25 minutes. The math is not in my favor. We will be moving quickly. I will slow down on key items. It gets better the deeper we go. If you enjoy quant strategies and lock in now, this should be a good time. Straddle. This is what we're going to be working with. You got put call, same underlying, same strike. And we're going to be vol trading it. That means it's going to be delta hedged. We're going to want our longs to have more realized than implied, and our shorts, we want more implied than realized. Volcanoes, what does that stand for? That's volatility, cross-sectional arbitrage, no extra strings. It's a systematic long-short vol arb, and you could call it a medium-low frequency strategy. We're using monthly straddles here. And I've got a pet peeve with back tests. You got to have the subprime meltdown. You got to have COVID. The headline here, Heston's option momentum allows an investor to harvest the volatility risk premia. You add in two more features that have real-world impact on the distribution of outcomes to form expectations for each straddle, and you've got a stew cooking. You can form a highly desirable portfolio off that. There's a focus on simplicity. Features are analyzed using the Nui West methodology. There's heavy utilization of the academic literature here. You've got Heston, Goyal, Chow, and Bali. Shout out to them. Of course, there'll be delta hedge to minimize that directional risk. The long-short construction will shield from systemic vol risk, and that diversification minimizes our idiosyncratic volatility risk. Does this equal a 5+ Sortino all-weather strategy? Let's up the ante. Can we do that with just a linear model after transaction costs? We will see. So I built the platform out of option metrics with Python. We've got about 1,000 to 1,500 straddles per month that qualify for ranking. To qualify, they have to be approximately at the money with open interest, spread below 50%, and at least 3 months of data that meet that same criteria. I linked that up with the underlying data from CRSP. We've got the price history for hedging and payoffs, got the earnings calendar out of IBES, and of course for validity, we need all the stock splits and ticker changes incorporated. And then for risk research and more enrichment, I added about 50+ stock characteristics. We'll see why the Fama-French factors and the industry classifiers are included up front. Now I modeled transaction costs on the straddles and the underlying using Mirovev's paper. Key to this, that 20% algorithmic transaction cost. He finds that informed traders using sophisticated algorithmic execution can average a 20% T-cost. Paired this with delta hedge selection, you can have that daily at initiation, before earnings, periodic, or with a sliding delta threshold. Expectation, you can get that in a linear or non-linear format. And if you want to add constraints, you can have long-short Vega per dollar restriction or enforce industry diversification. And if you so choose, you can make this a dispersion strategy using SPY as your long or short component. Liquidity filters, you take a second to look at those. For spread cost per Vega threshold, I normally use about 3%. Good line there. For feature selection, we're just about to get into that. You've got 4 choices, and you can get those normalized or z-scored. So option momentum, their first feature. It's simply the average of the last 12 months of option returns, and that's the delta hedge return formula. Now, I want to take a moment here and explain how this project came to be. So after undergrad, I spent 5 years doing corporate rotations at JP Morgan. In that environment, it can be hard to stand out. Everyone's good. Everyone gets the job done. With Lehigh's MFE, I saw a chance to transition to a role where the complexity of the problems affords more opportunity to differentiate yourself. So, when Professor Heibe introduced me to Heston's option momentum, and I recognized that it wasn't very well understood, but it was strong. In that, I saw opportunity. I started building last December. Come April, I came to Director Zora, and I told him, hey, I think I've got something. And Lehigh, being the excellent program that it is, he gets me a meeting at 0.72 Hudson Yards to present. And I pitch what I have at that point. It's a one feature, unhedged, no transaction costs, no liquidity concerns, completely frictionless model. And believe it or not, hedge fund managers not too impressed with that sort of thing. Fortunately, there was a head of quantitative research in the room who was familiar with the complexity of the platform I'd built to get to that bad strategy. And in that, he saw opportunity. A few weeks later, he reached out and we established the first sponsorship between Point 72 and Lehigh. Now, I've never been one to follow the beaten path, so having his expertise to establish guardrails on feasibility has saved me countless hours. No shot he has time to watch the recording, but shout out to him. Thank you, Alun. Let's keep it rolling. Second feature, Vol level. You may have heard it known as Vol premium. It's very well known in the academic literature, that mean reversion effect. And I'm taking implied volatility with a 3-month measure for my HV. My IV is just pulled directly out of option metrics. That's backed out of the Shoals. And my historical vol is the close to close last 62 trading days. Slope, as you can imagine, looking at this without vol level, this one's not going to be too useful. It's the 3-month HV minus the 12-month. Third, idiosyncratic vol. I found this in Chow's paper. It has a really nice monotonic nature to its portfolio sorts, which are going to be key in this model. You can find it in Beta Suite and WRDS. It's actually straight out of the Fama French model. As I alluded to, those portfolio sorts, if you're not familiar with the methodology down here, you can read that D1 as the top decile, so the largest difference between your implied vol and your HV. And if you formed a portfolio off that every month for the entire time series, your mean would be there. And your new US T-stat, you can read that as the statistical significance away from 0. So when you look at the long short of D10 minus D1, that's if you formed a portfolio, longing D10, shorting D1. And when you have a positive new US T-stat on there, in some contexts, people refer to that as alpha. Bull slope, you can see at the extremes, it might have some value, but on its own, not very useful. Momentum, affectionately called MOM, shout out MOM. Idiosyncratic volatility, I've got that IVOL. Check out that nice monotonic portfolio sort on both these guys. That's going to be essential. Everything after this slide is going to be after transaction costs. It's going to be 30 longs, 30 shorts, that 1-month hold'em we've discussed. Everything's daily delta hedged. We're not going to enforce any additional constraints. On our left here, we have the linear model and the features used in it. In white, you have your Nui West T-stat for the monthly return. Sharp, Sortino, and max drawdown have been highlighted. As mentioned earlier, you can see that slope on its own does not have much value. Bull premium looks like it's got something there. But when you put them together, you see the value, including slope in this formulation, it becomes much stronger, and that reflects in the Sharp, Sortino, and max drawdown as well. Next, I draw your attention to bull level, which is more well known than momentum. However, momentum, much more statistically significant. Better Sharp, better Sortino, better max drawdown. Let's look at the best 2-feature, 3-feature, and 4-feature models. You can see they improve as you go. And I want to deliver here. There's your 5 Sortino after algorithmic transaction costs with just a linear model. Next, if you're more of a visual learner, check out blue vol premium, orange momentum. Notice how vol premium, up until 2012, you could get away with a single variable regression model if you had everything done right, but then you're just bleeding out transaction costs. But momentum in orange, it's got that tortoise in it, slow and steady. You make it a little bit more sophisticated, you add slope, you get that green line, and you run that. Well, you can get away with that till about 2015, at which point the market gets more efficient. You run into the alpha decay problem, and we'll get into that in a second. You need to have momentum to keep it going. You might think, looking at the yellow line and the light blue, do we really need that 4th feature? If you're familiar with log scale, you know what happens when it drops. Yeah, you do. It's a huge difference. The 4-feature model is what's really kicking here. That alpha decay, take a look at how long that vol premium works and how it drops off very rapidly. You add in slope, you get away with it for a little bit longer, but then you're going nowhere. Compare that to the 4-feature model. Now, what could have happened in 2017 with the 3 features being volatility related that would make this model underperform? The VIX was bumping off record lows all year. There wasn't a lot of differentiation in those vol features for the model to pick up. Moving into a more granular view from annual to monthly. And check out the time series here of that 4-feature linear model. You see it's a little bit weaker in 2017. Again, I ask, what happened in mid-2013 that could give it the worst month performance it has? That negative 14% drawdown. Familiar with the taper tantrum? Ben Bernanke announced the end to quantitative easing. Caused a lot of vol strategies to underperform during that time and in the months after. If you're comfortable with the complexity of a nonlinear model, you do get rewarded for that. An XGBoost formulation with these features, even though there's only 4 and they're normalized, there's not a lot of nonlinear activity to pick up on. It does outperform significantly. You do get rewarded for that. An overlay of that nonlinear model, the XGBoost and the multivariable. You may notice that the XGBoost has a lot more conviction in its positions. It typically has stronger highs, but it also draws down deeper when it does. We'll see in the metrics, those risk-return ratios, if we actually should move to that nonlinear model or not. Check out the skew of the monthly return series on this guy. And that kurtosis, that's in your favor. Again, this is all after that algorithmic transaction cost. There is no evidence of crash risk in a 2-decade backtest. Let's take a look at it by the numbers. We'll focus on the 4-feature models, the linear, multivariable regression, and the XGBoost. When you take a look at the Sharp and the Sortino, yes, you do get rewarded for that little bit of extra vol. You get enough return where by the stats, it looks like it is, in fact, worth it. The Colmars, it's unheard of. So model risk. We do have a time travel problem in this model. Like in a lot of academic literature, I'm using closing prices. And I'm assuming that I can form next month's portfolio simultaneously as the prior month expires. In reality, you need to wait for the capital release, put in the orders the next day, whatever. Data source look-ahead bias. It's possible I'm syncing up a lot of data here from a lot of different sources. One of them could have some future data leaked in. Survivorship bias. Say a stock gets delisted or taken private. Given the long-short construction of this, I think this is probably a lesser issue. Take a look at this under the hood of what the nonlinear model is picking up, the positions it takes on over this whole 22-year backtest in this case. Shorts are in orange or longs are in blue. It would be fair to ask, are you just picking up the liquidity premium with this one? I would push back on that and suggest no. This is an aspect of the momentum phenomenon options. You've got less informational diffusion on these smaller cap stocks, which makes them more likely to have that mispricing. And that informational diffusion difference comes from them having less institutional ownership, less analyst coverage, less public interest in general. And I'd support that claim by showing you the open interest of the positions that get picked up. Note the difference is not that big. And this makes sense given our expectation formula accounts for the anticipated transaction cost when forming the portfolio. So a small cap stock that has a large bid-ask spread wouldn't get included in the first place. Again, looking under the hood of the nonlinear model. It looks like it picks up a lot of healthcare. Why might that be? What is unique about these healthcare stocks in terms of vol? Well, you've got a lot that just bleed out cash until they find something. You've got regulatory risk. You've got drug trial breakthroughs. It's a pretty unique sector. But as far as the systematic risk that this poses, I can tell you in the months preceding and post the American Affordable Care Act, there's no discernible difference in the performance of the strategy. even within the healthcare sector, there's diversity of stocks. And given the overall diversity of this portfolio, it does not seem to be a concern. A production system, I'm in the process of merging this with Polygon to get up-to-date information. I'll be using limit orders based on the acceptable bull price in IBKR, what the model gives me. And now there's a flexibility advantage to this. We've been talking about the top 30 and bottom 30 positions. If, however, we can get price improvement deeper in our expectation ranking, it can be just as good. Now, paper trading will be great to validate the execution and delta hedge algorithms, but there's going to be a deficit on fill prices. With paper trading, you don't get access to the order book depth, so we won't actually know where we fill. And now that's a major problem because this strategy is transaction cost sensitive. And what I'm trying to illustrate in this poorly scaled graph here is that the more transaction costs you're willing to take on, the higher your probability of execution will be. And as you go deeper in your rankings of your orders, the further down, the less likely you have for probability of execution. And given this, as we increase the portfolio size, the market's going to move against us. We're going to shift down on that probability curve. Knowing these factors, what can we expect in a go live scenario? Well, we're not going to be able to stuff 100 million in this and get $70 million a year back. Like, it's absurd. Maybe, if you believe Mirvev's paper, we can get 100K at that 20% effective TC, moving to 50 TC at $1 million, and maybe we end up at 75 TC with 10 million. It's hard to speculate. So what could the opportunity here be? Well, if you take a look at the 5 largest market drawdowns for the SPY index and how volcanoes, the algorithmic formula, performed in that time, you see it's an uncorrelated alpha. So even at that 75% TC, you still have a 1 sharp, 2.5 Sortino. If you were to merge this, if you were to diversify between the market index and some volcanoes, you'd improve the overall risk profile of your portfolio. Now, there are other straddle features in the academic literature that have that nice monotonic portfolio sort nature. With access to institutional quality data, I believe I could curate those and push the capacity of this strategy out further, potentially positioning this as something that a hedge fund would have a good deal of interest in. Some closing thoughts. This project has brought me a lot of joy. I've been working on it for about a year now. I'll burn entire weekends opening up the optionality, adding position sizing, regime modeling. Sometimes I'll grid search that whole thing when it's opened up. And when you're looking at the thousands of models that come out, you can find a model that easily performs better than Volcanoes. What I love about Volcanoes is 4 features normalize 0 to 1 every month, and a linear model is all it needs to kick. I find beauty in that simplicity, and I'm glad I got to share that with you all today.